97% of money managers lose against the market. What are your chances? Investing well is one of the most sought after skills. After all, what better way to earn a living than watching your money multiply in front of you without having to do all the work that goes along with normal jobs? There are investors that have shown consistent market-beating returns in all types of investment. I decided to try out 3 of them. First is swing and day trading in crypto. There are investors like Renaissance Technologies and Sam Bankman-Fried from FTX that have made their living doing this for many years now. Second, I'm going to be investing in deep value fundamental investing. There's a whole host of investors, starting from Warren Buffett all the way to Connor Haley at Alta Fox Capital, that have had amazing returns with this model. Lastly, we'll look at how you can beat the market with as little work as possible, using passive investing for the most part. So can you beat the market day trading? To answer this question, I joined a swing trading group for 30 days and put $10,000 of my own money on the line. After spending a couple of weeks watching all the traders in this group, I found 1 or 2 that really vibe with the way that I like to trade. After learning everything I could from this one trader, I started charting my own charts and creating levels at which I would buy and sell certain coins. I set alerts so that I could be ready to buy and sell at any time. Over the next 30 days, I would get trade alerts at all times of the day, sometimes even at 3 in the morning. Over this period, I clocked in a total of 9 trades. With those 9 trades, my total return was 5.5%, where 75% of them actually made money. This sounds amazing, right? Not really. This 5% return came with a lot of pain and uncertainty. By the end of my 30 days, we had entered into a bear market in crypto, and finding good trades became harder and harder to do. For me, my takeaways during this period were pretty unique. 1, I was surprised that you can actually make money by trading in crypto, at least in the short term in this 30-day test that I did. Having tried this before in stocks, I knew that this is a really difficult strategy to pull off. It turns out that trading crypto is actually a lot easier than stocks. Of the trades that were being posted on this group, about 75 to 80% of them were winners. Despite that, day trading wasn't for me. Given the huge interest in the crypto market and the growing way that it's evolving, I don't expect this type of trading bear fruit for that much longer. Similar to how quantitative funds took over this type of trading in stocks, I expect similar things to happen on crypto. Next, I wasn't willing to be plugged in 24/7. I'm the kind of person that looks forward to flights because you're forced to be unplugged during the time you're out up in the air. This made it so that I couldn't do as many trades as I wanted to. Trades where you're only looking for a 5% move in one direction or the other won't wait for you to finish near. Next, I couldn't get myself to hold more or less completely worthless assets. For instance, sometimes the best coin to trade was Dogecoin, but I felt uneasy owning these coins even for a short period of time. On the other hand, the best day traders and swing traders seem to disdain fundamentals in their entirety. Some of the best short-term investments are terrible long-term holds. I know traders that made over 2 times their money on a coin called Collect. Soon after the pump, it crashed more than 98%. If you were still holding the bag, you had lost almost everything. More than anything else, most traders end up making their real money in trading on leverage at 10x or 20x leverage. For me, I couldn't get my head around that level of risk for any sizable investment. Hi friends, my name is Mize. I'm a hedge fund analyst turned entrepreneur, and on this channel, I break down the top investments out there today. So now that I've decided I'm not a day trader, let's jump to fundamental investing. Can you beat the market while picking stocks? The answer to whether the stock picking can beat the market is a definitive yes. I can point to 20 or more investors that have long track records proving this point. You can start with Ben Graham to Warren Buffett and Charlie Munger and all of the disciples that came after them. Some of the more recent managers include Li Liu, who has supposedly a 30% annualized return since 1998. So next, the real question is, can the average person beat the market while picking stocks? And yet again, the answer is theoretically yes. If you are willing to put in the work, you can beat the market while picking stocks. Even in this regard, there are some great examples of non-professional investors that have long track records. The first one that comes to mind is Dan Shum of NoNameStocks.com. He has a nearly 50% annualized return since 2013. He focuses on very small companies that have been essentially left for dead. Another great example of a non-professional investor who has now become a professional investor is Moustache. He started his investing career by voraciously reading everything that Warren Buffett and Charlie Munger had written, and then using their principles to invest in India and also in the United States. His returns while he was still running his own software company were in the 30 to 50% annual range for many years, after which he decided to start a fund and become a full-time money manager. So having these examples of professional investors and even non-professional investors that are able to do it, how can you and I do it? From what I can see, there are 3 secrets to their success. Let's go through them. 1, these investors find their investments where others are not looking. They look to invest in underfollowed, forgotten about companies where it's unlikely the Warren Buffetts and the Charlie Mungers of the world are also going to be looking. As a result, they have much less competition. These investors are able to hunt for gold where no other investor is willing to go because they cannot deploy the amount of money that they have to deploy into these small underfollowed companies. An example of a beaten down and forgotten stock that I bought last year after COVID was HMHC. I was able to get it at $3.42 and it recently got taken out at $21. These are the types of opportunities that you have when you look for value in places that others are not looking. HMHC was beaten down to the point where it was below what most investors would consider investable. And as a result, it became a great place to find a diamond in the rough. Next, they clone top investors. Moustache, for instance, famously calls himself a shameless cloner. He lets other smart investors do most of the groundwork, and then he chooses his investments from what others have already invested in after he's done his additional research on top of it, and he also agrees on the thesis. A great example of a stock that I recently bought in this regard is Berkshire Hathaway. I saw that Berkshire Hathaway was buying back its own stock recently, and I took that as a telltale sign that Berkshire Hathaway is a good investment at this time. If it's good enough for Warren and so many of these other investors, it's got to be good enough for me. Lastly, what all of these fundamental investors have in common is that they invest for the long term. They have a belief that the stock price will move towards the intrinsic value of the company over the long run. You'll find many investors today and large banks following many stocks often change their price targets quarter to quarter based on how the company is doing one quarter or another. Most fundamental investors look to invest in a company as if though they were an owner and plan to hold the company for 5 or 7 years. When looking at the company as an owner, you end up being able to wait out times of uncertainty because you know what the long-term trend looks like. One of the stocks that I've invested in for the long term is IDT. Since I bought it, it's down almost over 30% along with the rest of the small cap market. But I've been adding into my position because I continue to see the underlying KPIs of that company continue to perform well. And I think in the long run, the price will start to converge at the actual value of the company. By looking at this company as a long-term hold, I'm able to invest more money when the price is down further. There's an intrinsic belief the market is not efficient as a fundamental investor, and I agree with this wholeheartedly. As a result, I'm able to buy more when I think things are on sale, and then choose to sell when I think things are overvalued. My results as a fundamental investor are harder to track. Over the short period of time, the 6 to 9 months that I've been doing so, I have done reasonably well because I had one amazing stock pick. But that doesn't mean that that's how I'll continue to do in the future. The hard part about fundamental investing is putting in the time. Finding good stocks that you can choose to put your money behind and hold on even if they're down 50% or more. If you're willing to put in the time and effort to get that level of conviction behind the stocks that you're picking, then you might be able to go down this route and see if it works for you. For me, fundamental investing makes a lot of sense and I enjoy doing it. At the same time, I invest a lot of my money passively, and I'll show you how I beat the market doing that next. If day trading and researching companies isn't your jam, you can still beat the market by buying ETFs. So how does it work? One of the best ways to invest passively is to use ETFs and tax loss harvesting. Many robo-advisors like Betterment will do this for you. By doing this the right way, you can add 1 to 2% of alpha to your returns after taxes. Me personally, Betterment has tax harvested about $18,000 on a $110,000 account in the last 2 years or so. That equates to about $6,300 in savings. Those savings I can now use to buy more of the same funds that I've already invested in. And those savings of $6,300 will earn about 7% every year. In this case, that's about $440. Those $440 are more than paying for my Betterment fees of $250 or $270. On top of that, I haven't even accounted for the principal and the ongoing growth in tax loss harvesting that I'll continue to get as an investor in Betterment. I've linked a couple of great resources, a white paper from Betterment, as well as a post from Mr. Money Moustache showing exactly how this works. You can even tax loss harvest in your own account without a robo-advisor, with your own mix of ETFs. Like I said at the beginning of the video, the majority of investors don't beat the market. And of those that do, most don't do it for multiple years in a row. Passive investing with tax loss harvesting, for me, is a benchmark. Before committing to any major form of investment, I spend time pitting my own strategy against index funds to make sure it's worth putting my time and money into a new strategy. If I can beat the index funds, I'll add more capital to that strategy. Most of the time, I'll find beating the index funds is more work than it's worth. The passive investing option can do things that you can't without a lot of the emotional turmoil. As I've shown, beating the market isn't impossible. It can be downright easy if you take advantage of the tax laws in your country. Even more, some of the best long-term investors came from non-financial backgrounds. In my next video, I'll go through how one such investor has beaten the market for 20 plus years. Check it out here.